And welcome back to another episode of the Brutally Honest Loan Officers. There's two of us podcast, which is just got myself in there. I am Steven, and with me, as always, is Mr. Derek Brown, and we are loan officers here in Florida. Derek, say hello.
Hey, Steven.
How was your weekend? How was things going?
Weekend was good. Um, we we went to Epcot
Yeah, of course you did.
Saturday morning. We decided to go to Epcot. Um,
You
no,
just drive. You just drive
Sunday.
back home, right? You don't.
No, yeah, Saturday morning we went to Epcot. Then came home, put the kids down for nap and stuff, and then went over to a friend's house to watch some football. Ate some chicken wings. Um, then the next on Sunday we woke up. I went over to my mother-in-law's house because she has a moke. You know what a moke is? It's a super fancy golf cart. Like that's what it is. It's a little electric vehicle, but it's street legal and stuff. So we went to go take that and go downtown Sanford and go to the park. We grabbed some bread to feed the ducks. And then on our way home, we stopped to get a donut. So Donuts to Go is like a local place where they have like insane donuts where
Okay.
like Oreos on top of it, Sour Patch Kids on top of them, like all kinds of different things you could think of, like way over the top.
Yeah,
You
yeah.
get diabetes from eating one.
Oh yeah, we got that. We
Uh,
got Jupiter Donuts here. That's what that is.
okay, so same thing. So we stopped there, had a donut, and then hopped on the moat, headed home, and it died. It broke down. Like so, it's electric vehicle. And when I went to go get it from my mother-in-law's house, there's a certain way you have to charge it. You have to like pull a button and charge. And this had been connected to the charger, but the button was pushed in, and that's how you store it, not charge it. And so she's like, I think it'll be fine or whatever. But there's no gauge on how long you have, like the little uh
It doesn't tell you?
sensor. Well, it's supposed to, but she had put like a supercharger in it type of thing that allows it to go like 35 miles an hour, which makes it safer for us on like two of our roads.
Yeah.
So it doesn't show the battery life anymore. And usually, like we just watch how many miles because you can get like over 30 miles on a charge.
Yeah.
And we never go 30 miles, so it's not a big deal. Well, we didn't make it.
Yeah.
So
Ooh.
I had to call a buddy. Well, I called my wife. She came and picked up me and the kids, and we left the moke down the side of the road for a minute. Called a buddy, went and picked him up, then came back just with a simple rope. We just towed it home. I was in the moke driving, like hitting the brakes when he hit the brakes. Probably not the safest way to go, but we were so close to home. It was literally like 3 miles. Brought it home, and then that was
Actually
it. And
charged
then,
it.
yeah, and then we had fall festival for Bennett at his little school. They did like a trunk or treat and um like a haunted forest thing or whatever. It's fun.
Yeah.
What about you?
We sat at the swimming pool for 4 or 5 hours. And by that I mean we were at Joey had his first like competitive swim meet.
Oh, nice.
So he did that. All the different kinds of strokes. He got fifth place on one of them for like, hey, I've never done any of this. But then he was like, this is easier than practice. I'm like, yeah, because you're doing 25 meters of breaststroke, butterfly, freestyle, and backstroke. That's all you're doing. Like you're
Right.
you're you're doing 100 meters worth of stuff. Like
And
that
that,
takes you that you might have
yeah,
swam a total of like, and then your warm up swim. Like you might have been in the pool a total of 10 minutes. When you go
right.
practice 3 days a week at an hour and a half each, like yeah, of course it's much easier. But he liked it. It was just good to get them into that. The coach is like, hey, we're just here to be here for them. Like this is just to be fun
Right,
for
right.
them. Like
That's
they
fun.
have they have no times. They don't even know like what they're even like trying to get to. I mean, they time them, but it's like they've never done a competitive swim, so they don't know. You know,
They don't know if it's good or bad or
yeah. So
what.
like
They're
the
just
next
out there
one,
to
yeah.
and have fun.
I mean, they're all. I think he's in the older group. Like on his team, there's two of them that are eight that are together. And it's funny is like they were neck and neck the whole time. They swam like in sync with each other.
Gotcha, gotcha.
And there's
Okay.
other like kids, but yeah, it was good. And then yeah, we cleaned the whole house, did all that kind of stuff. And my wife's like, well, we should walk the dog, but we should see if our neighbors, Mike and Lori, want to have a drink like around the corner. So of course we were walking and they're like, oh yeah, let's just hang out. Then that was 3 o'clock in the afternoon, and we're there till 8 on their front porch having a drink as
Yeah.
the kids play. And the dog is like, "This is BS. You said we're going for a walk, and we went
We
four
walked
houses
around the
down."
corner and stopped.
Like, this is horrible, but yeah, it was good. So, but all right,
Listen,
what is our topic today? Enough about us. Nobody cares. Let's get into
well,
it.
we were talking about business a little bit. And we always see like a little bit of a slowdown when we get into the holidays. A little bit more of a slowdown right now because we got an election. Like there is an article that came out talking about prospective buyers and how like 25% of those buyers are on the fence right now, waiting until after the election for various reasons. But it's opened the doors for some of my buyers. So I started looking at my pipeline, seeing exactly, what kind of deals my current buyers are getting. And over the last couple of weeks, I've had 4 buyers go under contract that received an average of over $21,000 in seller credit, which is a lot.
Yeah,
Like that's not
that's a lot.
normal, but it seems to be like the new normal right now. It's just
Well,
the current market we're in. Like,
I'll even
um,
say this. I thought I saw the post in our area. I need to see what if it was for single family homes or what, but I know single family homes is getting up there too. But it's actually we have it was a little over 7 months of inventory. They say, okay,
right,
balance market's 6. You start going the other way, then it becomes a buyer's market where they get these credits and get more what they want. Almost the
right.
opposite of what we had in 22, where it was
Oh yeah, well, I mean, when
seller market.
COVID hit and we had super low interest rates,
Yeah.
I mean, they're like a $400,000 house that was, or a house listed at $400,000 was going under contract with a buyer that was willing to pay 440, pay over the appraised value, and cover some of the seller's closing costs.
Yeah.
I mean, it was the complete opposite. So right now we're looking at, several buyers really getting some awesome deals uh for the homes that they're going under contract for.
Well, no, let's go now. So what is a seller's credit? So that's the biggest thing. A seller, so we're starting to see these more. I mean, you used to maybe had a little bit of one before, but like now they're very, very common. And a lot of people don't know what they are or how much they're actually legally allowed to get, depending on their loan type and
Right.
everything else. So let's really get into it. So a seller's credit is when the seller agrees to actually contribute a portion of the purchase price, so whatever number that is, back to help cover closing costs, down payment, anything to do with the loan. That's what they're putting it in
Not
for.
down payment though.
Well, you still
Outside
got
of
to
down
put
payment.
yeah, you still got to put your down payment in, but they're allowed to give you the loan origination fees, title insurance, all that stuff they can actually cover.
Right. Yeah. So just getting a little bit of extra help to reduce the cash needed for closing. So like I mean, just right now in today's market, that can be huge. If you've got somebody that's saved up the down payment and they're, I've got some savings and reserves, but I don't want to use that, so I've got to save a little bit more to cover the closing costs. You actually might be able to go under contract now, get that covered, and then you're able to save more money in pocket. Well,
Exactly.
and like there's times where we're not talking about like getting a seller credit towards repairs that we know need to be done. This is like we're getting seller credits just to cover closing costs. We're buying down interest rates. Um, so there's it creates an opportunity for the buyer to get really creative in creating a loan that really works for them. That's what
Yeah,
we're seeing.
just as you said, like it's a lot of people think, oh, seller's credit because of repairs, but you're seeing them put in the first offer asking for a seller's credit.
Yep.
So they're not
Like
even
one of my
doing any.
buyers put in, we're doing an FHA loan. They wanted the seller to pay a little bit of their closing costs so they didn't have to come out of pocket. And we were probably hoping for like 2% ish. But I was talking to the real estate agent, talked to the buyer, and I said, like, why don't we just shoot our shot, see what, they come back with. So we went in at list price and asked for 5% seller concession, thinking that we would land around 2%.
Yeah.
They just accepted. There was no rebuttal. There's
Yeah.
no like questions. They just accepted. Perfect.
It's,
Okay.
the
Good
market
thing
has
we
changed.
asked.
The market's more balanced. The market is, it's not technically a buyer, every area is different, but some areas might be more of a buyer's market, but it definitely has changed where that negotiation is a lot more towards the buyer than it has been in a long, long time.
Right. Yeah. So it's becoming more common. Um, So we do kind of want to go over like how they can use it. So how can a buyer use a seller credit? Um, Simple answer is just to cover your closing costs. So
Yeah.
your closing costs, and there's two sections of closing costs that we break down usually. There's your closing costs, which are lender fees, title fees, and then there's your prepaids, which is you're only paying prepaid interest, and then the prepaids for your escrow.
Yeah.
So that's prepaid insurance. You pay for insurance for a full year upfront, and then you're also going to pad your escrow account, which is usually 2 to 3 months of insurance and 3 to 4 months of taxes. Some lenders do that differently. We typically do 3 months of insurance and 4 months of taxes.
Yeah.
So that's your
And,
closing costs and prepaids.
and that though people don't understand escrow, that escrow account is you're just putting money into the escrow account because your first mortgage payment isn't right when you close, but your insurance is due in 12 months and you only will probably make 10 payments in that time frame, maybe even 9 payments in that time frame. So instead of like, hey, you owe a bunch of money in a year, they just start collecting it up front as part of the closing cost. So it kind of protects you, like, hey, I'll just put this money in now instead of I'm in this house and suddenly I owe 1 month, I owe an extra 4 or 5 grand or whatever it is that I wasn't expecting.
Right. Well, and like I did mention earlier that buyers are on the fence right now because of the election, but the other, probably the number one reason why some buyers aren't trying to make offers right now is because of higher interest rates. Interest
Yep.
rates are a little bit higher. We thought they were going to start coming down. They did, but they've gone back up. Just other economic factors that have come into play. So interest rates have kind of gone up a little bit. And one of the most common things we're doing with this seller credit is using it to buy down the interest rate. So your interest rate started around low 7% maybe, and they're getting to low sixes and using the seller's money to pay for it.
Yeah, exactly. I'm telling people right now, okay, they're so focused on their rate, and I'm like, you're most likely going to refinance in a couple of years or eventually move out. That you have to make that ROI make sense. But if a seller is giving you enough money that you can buy down the rate, you're using somebody else's money. So your ROI is right now.
Right.
So that's the great part about using them to help buy down the interest rate with it. So it's a great thing to do with it.
Yeah. So, I mean, there's two numbers that we really focus on when somebody's getting pre-approved or, I'll have a buyer send me a house, Derek, can you run the numbers on this and tell me like exactly where we'd land based on what we've talked about? And there's two numbers we focus on. It's the monthly payment and your total cash to close.
Yep.
So if they like are totally fine with the cash to close part, but that mortgage payment, they're like, man, it's just a little bit higher. There's some things that we can do to try and lower that. So buying down the interest rate could help there. So it's really creating a win-win for some of our buyers that are, wanting to move forward now instead of trying to wait. Also, I mean, the waiting factor, we've said it so many times before, time in the market is better than trying to time the market.
Yeah, exactly.
So if basic economics says right now, there's the inventory that we have is creating, buyer's market. But if interest rates go down, several other buyers will come back into the market, which then should drive home prices up. So then if you're, trying to, let's just say you want to buy a $400,000 house and you've got 5% saved. So that's $20,000. You've got a little bit of a cushion after that. You might be able to buy that house now if you got the seller to pay your closing costs.
Yep.
But if that house goes up to, I don't know, 420,000, now you're looking at an extra $1,000 that you'll have to come just in down payment. Just in down payment. And if there's more buyers making offers, you may not be able to get the seller to pay those closing costs. So that could be another 10 to 15,000 that you've got to save and
Together. Yeah, exactly.
just
Well,
because you waited and interest rates went down a little bit.
now so getting a seller credit, great thing, but there's restrictions on it, right? Like depending on what type of loan you're using, whether it's FHA, VA, conventional, there's limits on how much the seller can actually give you. And the
Right.
biggest thing you can't think about is what people think like, well, I need 5 grand, and the seller says they're going to give me 10, so that I'm going to get a $5,000 check at closing from them. You're not. They're not going to let you walk away with it. So what's going to happen is, for example, on a conventional loan, with less than 10% down, the max a seller can actually contribute is 3% of the purchase price. That is the limit.
Right.
You can, though, we were talking about this earlier, is I had a client where, they negotiated a credit back. They negotiate the credit back off a dollar amount, not a percentage.
Right.
And they didn't realize that they were actually about 5.5% on a conventional loan. And they were less than 10% down. So they could only have three.
Right.
But the seller was going to stay in the property for the next, I think, 2 months, right
Post
before.
occupancy
Yeah,
agreement.
they had a post occupancy. The seller was going to stay there for free. The guy didn't need to move. The buyer didn't need to move in right away, but he was okay with it. So what happened is we renegotiated it, is saying, hey, instead of letting the seller stay for free, if you're trying to get X amount of dollars and you can only, let's just say, hey, you're trying to get 10 grand, but you can only get five, then you can charge the buyer or the seller 250 or 2,500 each month that they're staying there, and there's your other 5 grand that you're going to get because now they're technically renting it back from you.
Right. And
That
that's
that's what
after
they.
closing. So not contributing towards
Oh
seller
yeah.
concessions.
So they were not no longer contributing; they were just renting it back. Now I
Now,
had
and we
maybe
are like, and I guess we should mention too, like this percentage that we're about to talk about. So conventional loans, when you're putting less than 10% down, you're limited at 3%. But that's also interested party contribution. Not like we're saying seller credit because that's what we're focusing on right now. But if you have a realtor that's also going to contribute, or you're getting a lender credit from the lender, that all gets added to the interested party contribution. So just keep that in mind too. We're focusing and just kind of calling it a seller credit, just for conversational purposes. But if you're limited at 3%, you can't go get more from somebody else either. So it's
yeah,
just total interested party contribution. Now, one thing I like to look at too is depending on the down payment on conventional loans, that limit changes. So if a buyer is doing a conventional loan, putting down between 10 and 25%, that seller credit limit goes up to 6%. So on a $500,000 purchase price, you can get up to $30,000 in seller credit if you're putting between 10 and 25% down. If you're putting over 25% down, you can get up to 9% seller credit or interested party contribution, which is a lot. Like a lot.
that's a
Almost
lot.
too much. We've got to really get creative on how we're doing this.
Yeah.
At
Remember,
that
that's
point,
this
you're
is
spending
for this is for primary.
primary homes. Yep.
Yeah.
Investment properties, regardless, limited at 2, regardless of your down payment. And then you've got FHA at 6, USDA 6. And then VA is a little different. And the VA, they say 4%, but we've gotten away with more.
It's
Have you
four
done that?
percent, and it's very gray. Because
Yeah.
the seller is giving you these things to the money to help you for the closing costs. Well, the seller, you could just write in, hey, the seller is going to pay for these things and give me a credit. So now, therefore, they're paying for those things, but it's not counted as the seller credit percentage. So they can say, hey, I'm going to pay all your title fees. It's no
Right.
longer part of, I'm going to pay all your title fees and give you 4%. So that could be 5, 6% technically that they're paying out of pocket for it, but how it's written on the contract, they're only giving you the 4% and then paying the title fee. So they're allowed to pay for certain parts of the contract without it actually counting to that thing, for the counting for the seller's credit. The thing I want to
Right.
also mention before we get too deep in it is these are, like you said, they are interested parties. But if a family member is gifting you money, that does not count for this because a lot of people are
Yep.
like, oh, I'm getting 5% from my family, so I can only get a certain portion from the
No,
seller. No,
that's a gift to
that's
your
a
down
gift.
payment. That's different.
Completely different thing. The gift money that comes from your family is completely different on that part of it.
Yeah, I've got one of my clients right now. We're doing a 2-1 buy down. So the seller's paying a fee for a 2-1 buy down, and we're using additional seller credit to just buy that interest rate down. They were super focused on getting that payment down. Even though I told them there's a good chance you're going to be able to refinance later. Right now, that's what they want. We were able to structure it to where they're starting with a super low rate for the first year. Second year goes up 1%. Third year goes up to the qualifying rate, which is still low considering what they bought it down to. So
Exactly. So
there's a lot of creative ways to use a seller credit too.
And I mean, I'm glad to see that they're back. It's not going to be back on every single house out there, so don't think that. But it is a negotiating tool, and for so long they were gone. It was just gone because of how the market was. So now you're seeing these people negotiate back, and it's technically like a win-win, um, because the seller isn't lowering the price, which doesn't really help the buyer too much because you remember you're having such a small percentage change of what your down payment. If they lower the price, let's say instead of giving you a $10,000 credit, they're going to lower the price $10,000. It's not
Right.
going to change your payment that much per month. It's your closing costs are not going to change that much on there because the percentage that the title and the state charges on the fees are like cents on the dollar compared to it.
Right.
So you're actually better off getting that credit. And it also allows the seller to actually have the higher price point. So it shows that the market is still increasing instead of them dropping their price lower and lower to try to get somebody.
Right. Well, I had a customer where they were talking about like I think we're going to offer like $10,000 less, and I was like, well, let's compare $10,000 less or $10,000 in seller credit, you know, which then allowed us to buy down the interest rate a little bit, nothing crazy, and then they use the rest of the money just to save out of pocket expenses, you know. But it was the difference of like reducing the purchase price by 10 grand, save them like $30 a month, and then using it to buy down the interest rate and save money out of pocket, save them like $120 per month
Mm-hmm.
and like $5,000 out of pocket.
Yeah.
So we opted for that. That just made more sense for us.
Yep.
You know, and that kept $5,000 in their bank, which is helpful. They're about to become new homeowners. So, you know,
So I'll tell
again,
everybody out there, just make sure that we recommend you guys talk to knowledgeable, reputable mortgage advisors.
right.
Derek and I. That's the only two you can talk to.
Yeah, there's a
But
selfish plug.
yeah, yeah, little shameless plug right in there. But
Yeah,
make sure you're taking advantage and knowing all your options out there. All the time I have people that I pre-approve, and I'm like, hey, sometimes you need a seller's credit, and you need this much. I'm going to let the realtor know this is how much you need. So when you go put that offer in, you're asking for that, and it is perfectly fine. You most likely will get it now as long as you're negotiating it correctly. I mean, people are like, oh,
right,
I'm going to ask them for $20,000 off and a $10,000 seller credit. I'm like, well, now you're asking them for 30 grand off because whatever you do a lower on the purchase price and the credit is lowering the cash that the seller is walking away with. So
right.
you kind of, you got to thread that needle carefully with it. You got anything else to add on this?
Don't. No, I think we covered it. Seller credits, good stuff. We're seeing a lot of it right now. Somebody has questions about it, you want to reach out to us, you know, shoot us a message, email, DM, something like that. Let
Yep.
us know. Otherwise, it's just another awesome episode of the Brutally Honest Loan Officers Podcast. I'm Derek Brown. Steven, thanks, buddy.
Thank you. See you guys next week.
See ya.